When it comes to investing, there's a few rules that I live by. Never invest based on yield alone. Never invest because a stock hit a new 52-week high, and never invest just because a stock hit a new 52-week low. Just because a particular stock hit a new 52-week high doesn't mean it can't go higher, and it also doesn't mean it's necessarily expensive. And conversely, just because a stock hit a new 52-week low doesn't make it necessarily a cheap stock, and it doesn't mean it can't go any lower. However, in today's video, we're going to take a look at 3 stocks that are trading very near or right at their 52-week lows to discuss, are they a cheap stock or are they cheap for a reason? And there could be further downside. But before we begin, do me a huge favor, click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, now let's get back to our video, taking a look at 3 dividend-paying stocks that are trading at or very close to their 52-week lows, beginning with stock number 1, which is Pfizer Incorporated, stock ticker PFE. Now, Pfizer Incorporated has underperformed, but it hasn't just underperformed. It has been one of the worst stocks to own here in 2023. Over the past 12 months, the stock is down more than 40%, and it now has a market cap of $162 billion. Back in December of 2021, during the depths of the pandemic, Pfizer shares traded briefly above $60 per share, which means if you purchased the stock at that high, you would be down more than 50% today. The stock is trading within cents of its 52-week low. The company saw a huge surge during the depths of the pandemic. After all, Pfizer had one of the primary vaccines that were being distributed at the time, but those sales have since fallen off. Looking here, you can see how the revenues are not just declining year over year, but even worse, they are declining every quarter practically. EPS has been no different, although they have been beating analyst estimates over the past few quarters. Shares of Pfizer are pretty much trading back at pre-pandemic levels, and the stock, now that the pandemic is gone and sales have come back to reality, they're in search of growth with no real growth plan moving forward, which is why shareholders have tossed the stock to the side, and it's a major reason why this stock isn't in my portfolio. If we want to look for some positive news when it comes to Pfizer, they have increased their dividend for 13 consecutive years. However, if a stock is down 50%, that doesn't really mean all that much to you. So I tried. Shares of Pfizer currently yield a dividend of 5.7%, and the payout ratio is creeping higher. So no real short-term concerns about the dividend at the moment, but we will keep a close eye on it. Now taking a high-level look at valuation, where we can see a huge decline in EPS for 2023 and a rebound in 2024, but still only 7.7% higher than pre-pandemic levels, which is a bit concerning. Analysts are looking for 2024 EPS of $3.18 per share, which equates to a forward earnings multiple of just 9 times, which is well below the company's 5-year average of 13.2 times. This is one of those stocks that appears cheap at the moment, but I also think it's one of those stocks that is cheap for a reason, and I'm taking a wait-and-see approach when it comes to Pfizer. Dividend stock number 2 is Deere & Company. Deere & Company, many of you know as an industrial giant, but more closely defined with the agriculture industry. Sure, the company builds huge machinery for construction, but a lot of their tractors are used by farmers in the agriculture industry. As a disclaimer, this is one of my son's top positions. When it comes to investing for my kids, in order to pique their interest, I try to invest in things that they can relate to, and my son loves tractors, so Deere & Company is one of his top holdings. On the year, shares of Deere are down 14%, and over the past 12 months, closer to 20%. Shares were actually positive through July, but since then, the stock has been trending lower and lower, making lower highs and lower lows. Deere currently has a market cap of $105 billion, and the stock is only 4.5% from their 52-week low. Like many other companies across various different industries, Deere & Company was one of the first to come out with guidance that showed slower economic demand. They looked for slower volumes, or they're calling for slower volumes and more of a normalized sales environment. Those are all near-term concerns, legitimate near-term concerns. But when you look at Deere and look at the long term, it's actually a very compelling company. They have their AI-like moment when it comes to driverless technology. Tractors out there driving without a farmer inside of it. Take a look at this video that they launched just last year.
The new technology that we're showing is an autonomous tractor, and it's the first time that we've ever been able to take the operator outside of the tractor.
This is our all-new John Deere autonomous 8R tractor and tillage tool. This is the same tractor that a farmer could buy today. It's the same 2430 chisel plow that they could go buy today from their local John Deere dealership. What we've added is the new autonomous components to complete the solution. So we've added stereo cameras on the front and rear of the tractor, and what you see is 3 stereo camera pairs on the front weight stack of our tractor.
That is pretty awesome if you ask me, and self-driving has a lot of potential for the company moving forward, but that's not the only growth driver for the company over the long term moving forward. Right now we have seen property values explode over the past 3 to 5 years, meaning farmers are sitting on some big time cash that they can tap into if needed to buy new equipment. So there are some long-term tailwinds to kind of mix in when it comes to Deere. Taking a look at the dividend, Deere has been growing their dividend at a strong clip the past 3 years with dividend growth rates of 38.2%, 14.3%, and 12.5%. Those are from years 2021 through 2023 respectively. Shares currently yield a dividend of 1.4%. In terms of valuation, shares of Deere do look compelling despite the economic slowdown headwinds that are expected. Analysts are looking for EPS to drop 19% next year and generate EPS of $28.20 per share, which equates to a price-to-earnings multiple of 12.8 times, which is not only well below a market multiple, but also well below the company's 5-year historical average of 16.7 times. This is definitely a stock to keep high on the watch list as they have a great balance sheet, free cash flow is once again growing, and valuation is intriguing. If you're new to investing or looking for a new brokerage account, then definitely check out WeBull. Right now, WeBull has a special promotion where if you sign up for a new account and deposit any amount of money, they will give you up to 12 free stocks that could be valued up to over $30,000. Definitely check out the link down in the description below. Dividend stock number 3 is BristolMyers Squibb, stock ticker BMY. If you've been following the S&P 500 during the course of 2023, then you know it's had a pretty solid year. However, not all sectors have participated in this rally. Outside of technology and communication services, which have been the top 2 performing sectors by a wide margin, one of the worst performing sectors in 2023 has been healthcare, which is exactly where BristolMyers Squibb operates. BristolMyers has a market cap of $102 billion, and over the past 12 months, the stock is down 37%, and it made a new 52-week low just in the past week. That makes 2 healthcare stocks on our list of 3 today, BristolMyers and Pfizer. However, when it comes to Pfizer, I have legitimate concerns about the growth moving forward. BristolMyers has a growth issue as well, but my concerns are as large. In 2019, the company purchased Celgene for a huge $90 billion price tag, which was expected to generate growth for the company. But it also came with a large debt bill with a $50 billion in net debt. Although top-line sales have slowed, they have not fallen off like Pfizer, and instead they have flatlined. BMY still generates $11.7 billion in free cash flow, which has allowed them to bring down their net debt down to $31.3 billion. With the stock down so much, management has actually taken advantage of this, utilizing their free cash flow. Back in August, the company announced a $4 billion accelerated buyback program. And on top of that, they just announced another $3 billion buyback program to go along with a 5.3% dividend increase. The 5.3% dividend hike marks the 15th consecutive year the board has lifted the dividend, and shares currently yield a dividend of 4%. In terms of valuation, analysts are looking for BMY to generate 2024 EPS of $7.43 per share, which equates to a forward price to earnings multiple of just 6.7 times. This is well below the company's 5-year historical average of 10.7 times. BristolMyers is still generating strong amounts of free cash flow, but they do need to find a growth path because it can't go on forever. They need to generate higher top line in order to keep that free cash flow going, which is exactly why the multiple is so low right now. So there we have 3 stocks that are all trading at or near 52-week lows. When it comes to which do I see the best growth trajectory and which do I see as the safest, I'm going to have to side with, in my opinion, Deere & Company. I like that driverless technology that they're starting to incorporate into some of their heavy machinery. Next, I'd probably have to side with BristolMyers. They still have a little bit of a growth issue, them and Pfizer, but they still have strong amounts of free cash flow, and they're utilizing that, both in increasing their dividend and also taking advantage of the low share price and issuing huge amounts of share buybacks. Down in the comment section below, let me know which of these 3 stocks do you think is the most intriguing at today's valuation. And if you haven't done so yet, make sure you smash that like button down below, as I truly appreciate it. It really helps with the growth of this channel, and we'll see you in the next one. Take care.